Welcome to the Deep Dive. We sift through the corporate reports, cut the jargon, and pull out what's really going on. Today, we're lacing up to look at Nike, Inc., specifically their fiscal 2026 first quarter results, which cover the period ending August 31st, 2025.
Yeah, and if you just glance at the top line, you might shrug. Total revenues, $11.7 billion. Okay, that's up 1% reported. Looks stable.
Still, yeah, but then you look at the currency-neutral number, right?
Exactly. Strip out the currency fluctuations, and it flips, down 1% on a currency-neutral basis. Not a huge drop, but it signals something shifting underneath.
And that shift, it hammered the bottom line, which is really our mission today, isn't it? To figure out why profitability fell off a cliff.
Off a cliff is right. A 30% drop, diluted earnings per share, just $0.49 last year, $7.70. That's a big hit.
And it seems directly tied to these win-now actions management keeps talking about. CEO Elliott Hill is focused on North America, wholesale, and running.
And the CFO, Matthew Friend, he basically warned us, didn't he? Said progress will not be linear.
So this wasn't an oopsie, it was a plan. A painful one, apparently. They're making a big strategic trade-off. Sacrificing profit now? Why? To fix inventory, seems like.
That's the core of it. Let's dig into that pivot because it starts with a massive U-turn on how they sell stuff.
Yeah, it's what I'd call the great channel reversal. I mean, for years, Nike was all about direct-to-consumer, DTC, digital first.
Their prized strategy.
Right. High margin, control the experience. But now, slammed into reverse.
The numbers are pretty stark. Nike direct revenues, $4.5 billion. Still huge, like 40% of the Nike brand total.
Sure, but currency neutral, down 5%. That's a serious slowdown in what was their growth engine.
And breaking that down, the physical stores were kind of flat, down just 1%.
Pretty much flat, yeah. The real drag, the shocker, was Nike brand digital, down 12%, from $2.3 billion down to $2 billion.
Wow. Okay, 12% isn't just noise, but is the market cooling on Nike online, or is this Nike pulling back? They did say they're reinvesting in wholesale and want digital to be a full-price platform. That's the key tension, isn't it? If digital is going to be full price, you can't keep dumping discounted shoes there.
Right. You got to clear that old inventory somewhere else.
Which means pushing it back to wholesale partners. And, well, look at the numbers.
While direct was shrinking, wholesale revenues jumped, up 5% currency neutral, hitting $6.8 billion.
So they're deliberately sending stock back to, the Foot Lockers and Dick's Sporting Goods of the world, the partners who can handle volume discounts to clear it out.
So the old school channel is actually propping up the numbers while they perform surgery on the newer channel.
That's exactly it. So for you listening, when you see those Nike deals at a department store or a sporting goods place, that's the win now plan happening right in front of you.
But it leaves that big question hanging, doesn't it? How much of that 12% digital drop is Nike slamming the brakes on discounts, and how much is maybe just less demand online overall?
It's the question to watch. Because one is a temporary strategic choice. The other's a bigger problem. And that channel pivot, it wasn't free. Not by a long shot. The cost shows up loud and clear in the profits.
Yeah, back to that 30% EPS drop, directly linked to the gross margin, which just collapsed, down 320 basis points, ouch, to 42.2%.
3 full percentage points of margin gone in one quarter. That's significant.
So what specifically did that? What were the culprits?
The filings point to two main things. Number one, the biggest chunk, about 250 basis points worth, was lower average selling price, ASP.
So basically discounts. The cost of clearing out all that inventory they pushed to wholesale?
Precisely. It's the direct result of that marketplace management strategy. They explicitly mention increased markdowns across Nike Direct and higher sales returns and discounts with our wholesale partners. They bought cleaner inventory with lower margins. Simple as that.
Okay, 250 points of discounts. What was the other 100 or so basis points?
Tariffs, higher product costs, and the big one cited is higher tariffs in North America. That costs them about 100 basis points.
Tariffs. That's an external factor, not a strategic choice like the markdowns. And it sounds serious.
It is. And unlike the markdowns, which are hopefully temporary, this isn't going away easily. Nike is estimating these new tariffs will add about $1.5 billion in extra costs annually.
Wait, billion? $1.5 billion a year.
That's the number they put out. It's a massive ongoing headwind for them now.
Wow. Okay, that changes things fundamentally, doesn't it? That's not just a line item. That forces strategic decisions. Do they move production? Do prices just have to go up in North America?
It definitely pushes them to diversify sourcing, but that takes time.
Mm-hmm.
Right now, it just makes bringing certain goods into North America way more expensive. They either pass it on to you, the consumer, or they eat it.
And it looks like, combined with the markdowns, they're eating a lot of it right now.
For sure. They're getting hit by the self-inflicted pain of clearing inventory and this big external tax burden at the same time. No wonder earnings fell so hard.
Did they manage costs anywhere else, like overhead or marketing?
Actually, yes. To their credit, selling and admin expenses were down 1%, and demand creation, basically marketing, was down 3%, so they are tightening the belt where they can.
But those two big margin pressures, discounts and tariffs, just overwhelm the savings.
Completely. Just too much pressure on the gross margin line.
Okay, let's look at how this played out geographically. Because the pain wasn't spread evenly, right?
Definitely not. North America, which they flagged as a priority, actually looked okay on the surface. Revenue up 4%, currency neutral.
Driven by that wholesale rebound we talked about.
Absolutely. Wholesale in North America jumped 11%,
Yep.
but even here, the direct channel felt the squeeze, down 3%, with digital down 10%.
So even in their strongest market, the strategy cost them. EBIT, the operating profit, for North America was still down 7%.
Right. Progress, but costly progress. Now compare that to Greater China. That was rough.
Yeah, China's critical for growth. What happened there?
Revenues were down 10%, currency neutral. Footwear specifically, down 12%. Wasn't good.
Was it broad-based or specific channels?
Oh, broad-based weakness. Wholesale down 9%, Nike Direct down 12%, and digital in China fell off a cliff, down 27%.
27%. Wow, that's way worse than the global digital average. And China EBIT dropped 25%. That sounds like more than just strategic repositioning. That feels like real market softness or competitive heat.
I think you have to assume it's both. Some strategic pullback, yes, but also genuine demand issues or competition biting harder there. It's a worry.
Okay, what about EMEA, Europe, Middle East, Africa?
Pretty sluggish. Revenue up only 1%, currency neutral. Same pattern, though. Wholesale up 4%, Nike Direct down 6%, digital down 13%, and EBIT there also down 7%.
So the global picture is remarkably consistent. Lean on wholesale for volume, take the hit on direct sales and overall profitability.
Except for one area that was just a disaster.
Converse. Yeah, we have to talk about Converse.
Yeah.
Those numbers were staggering.
Staggering is the word. Converse revenues down 28%, currency neutral. Just collapsed across all regions.
And the profit?
EBIT plummeted, down 68%. 68%.
Good grief. Why? Why was Converse hit so much harder than the main Nike brand? It's a classic shoe.
Well, the filings mention the usual suspects. Lower ASP, so heavy discounting again, but also higher warehousing costs specifically for Converse.
Suggesting maybe inventory problems were even worse there.
Could be. Or maybe Converse, being less of a performance-driven brand and more fashion lifestyle, maybe it's just more vulnerable when consumers pull back spending.
That makes sense. Less essential, maybe.
Perhaps. And maybe their inventory cleanup was just messier, forcing deeper cuts to move product that didn't have the same heat as core Nike stuff.
So let's bring it back to the balance sheet. Because remember, fixing inventory was the whole point of this painful exercise.
Right. Did it work? Where do inventories stand now?
Well, year over year, it looks okay. Inventories were $8.1 billion. That's actually down 2% from the same time last year. So progress. Okay, that's good. Liquidation seems to be happening.
It does. But there's a little but. Sequentially, compared to the previous quarter, May 31st, inventories are actually up 8%.
Up 8% quarter over quarter. Why?
They said it was product mix and just more units. You hope it's new season stuff coming in, good inventory, not the old problems piling up again. But it's something to keep an eye on.
Definitely. But maybe the clearest signal of the financial pressure they're under isn't inventory. It's what they did, or rather didn't do, with shareholder returns.
Oh, yeah. This was a big one. The capital allocation. They're usually aggressive buyers of their own stock, right? Helps boost EPS.
Always, but not this quarter.
Well, they returned about $714 million total, mostly dividends, which were actually up a bit. But share repurchases, only $123 million. Tiny.
And the really big news.
They stopped completely. Share buybacks were halted entirely in August 2025.
Wow. Okay, turning off the buyback tap is a serious move for a company like Nike. That signals real cash flow pressure, doesn't it?
Absolutely. The documents explicitly say it was due to lower operating cash flows. It just underscores how much that $1.5 billion annual tariff hit and the 320 basis points of margin compression actually hurt their cash generation.
So they're choosing cash preservation and fixing the inventory above propping up the stock price short term.
Seems like it. It's a painful choice, but probably a necessary one if the goal is long-term health. Stopping buybacks really highlights the severity of the current situation.
So wrapping this all up, it's a picture of, like you said, calculated pain. Nike is deliberately blowing up its recent channel, strategy boosting wholesale, throttling digital to clear inventory.
Even though it means tanking margins and taking a huge hit to earnings, compounded by external tariff pressures and weakness in China and Converse.
A 30% drop in EPS. That's the price tag for these win-now actions.
Which brings us back to that final lingering question we raised earlier. They say they're deliberately pulling back on digital to make it full price. Strategy.
A 12% drop globally?
Hmm.
27% in China. That feels fast. It feels like more than just turning off discounts.
Exactly. How much of that is strategy and how much is the consumer maybe just cooling off on Nike's digital offering or digital shopping in general?
Because if underlying demand is truly softening that much, then just cleaning up inventory isn't a long-term fix. That tension strategy versus real demand erosion, that's the thing you really need to watch going forward.
Couldn't agree more. That's the story for the next few quarters.
Absolutely. Well, that's our deep dive for today. Thanks for joining us. We'll catch you on the next one.